Hi, Edward. Could you provide insights on the key factors driving the Japanese equity strategy in 2025?
We think there are three factors impacting strategy in 2025. Firstly, rising interest rates. We saw the rate hike in July 2024 and expect more rate hikes in late 2024 and 2025. The number of hikes depends on the strength of wage inflation. Rising interest rates are positive for the financial sector, but are also positive in general as they signal a healthy and sustainable inflationary environment. Inflation will support earnings growth with higher pricing, but will also support the equity market as domestic investors look for an inflation hedge for over 1 quadrillion yen in cash assets. Secondly, talking about the impact of pricing power in an inflationary environment. So inflation will push workers to find higher paid jobs, which will drive growth and improve efficiency. Recruitment-related sectors will benefit. Also, better conditions for raising prices will benefit companies with pricing power. This will benefit niche industries with fewer competitors and strong brands in stable growth markets. There will be some zombie bankruptcies as a result of higher interest rates, so you should avoid companies with high debt positions in low or no growth markets. Thirdly, we're looking at governance and capital allocation. Capital allocation will remain key to the share price performance in 2025. We expect to see more cross-shareholding unwinding. In 2024, this benefited the construction and insurance sectors. In 2025, I expect to see more activism on this issue in the auto sector. The market may begin to open to more acquisitions. For instance, 7&i Holdings has become the bellwether for acquisitions in Japan, and it will answer the question, can good quality assets be acquired and managed better?
What impact does the US dollar-Japanese yen exchange rate have on the market?
The strength of the dollar will likely have an impact on the strategy as well. Volatility should be lower as the great yen carry trade has now fully unwound. I expect the underlying rate to remain around 140 to 150 yen, depending mainly on US interest rates. At an average of 145 yen, there'll be a small negative impact on exporters' earnings. The current average is 152 for this year. Exporters will need to rely on market share gains, pricing or volume growth, and weaker exporters without access to growth markets should be avoided.
Thank you, Edward. Could you also share your investment approach for capturing opportunities in Japan's stock markets?
In summary, our Japan equity strategy is well positioned to capture the opportunity of an inflationary environment as we focus on companies with strong pricing power who can maximize their free cash flows through effective capital allocation. The market as a whole remains very reasonably valued, trading on a low price to earnings multiple versus other developed markets.